You must diversify against the source of the disruption. We're moving beyond the Magnificent Seven and allocating to the rare earth materials, the specialized power grid infrastructure, and the high-end industrial automation components, the picks and shovels of the AI revolution. We need long-duration U.S. treasuries, which would soar in a deflationary panic, paired with select frontier market debt, which is largely uncorrelated to Silicon Valley's fate. This allocation hedges the systemic risk of tech innovation destroying demand, providing the necessary liquidity to scoop up cheap assets post-shock. Our second black swan is catastrophic geopolitical shock, a sudden escalating conflict in a major trade choke point. Think the Straits of Hormuz or the Taiwan Strait. This triggers an immediate dramatic surge in energy and commodity prices. Supply chains vaporize and investor confidence evaporates. This is a stagflationary shock where growth stalls and prices soar. Dalio's principle number 2, maximize portfolio resilience through pure commodity exposure. In this regime, paper assets suffer universally. Your hedge isn't a silver ETF, it's physical access. We need a higher than typical allocation to diversified global commodity indices, especially energy and agricultural futures. Furthermore, we apply Dalio's concept of a small tactical allocation to currencies that are not the US dollar or euro, specifically those backed by deep sovereign commodity reserves, acting as a non-Western hedge against global political fragmentation. This portfolio segment is specifically built to benefit from the panic-driven scarcity and breakdown of globalization. Our third black swan is persistent structural inflation. This isn't the temporary post-pandemic spike, but a decade-long grind fueled by deglobalization, massive government debt monetization, and a shifting labor capital power balance. Inflation remains stubbornly high, eroding purchasing power year after year. Dalio's principle number 3, diversify across currencies and real assets with pricing power. This is the regime where cash is trash and most bonds are liabilities. Here, we aggressively allocate to inflation-linked bonds, which are designed to adjust to CPI. Crucially, we use the core Dalio belief in real assets. We're talking commercial real estate with short lease cycles, which allows for frequent rent adjustments, and high-quality utility stocks with mandated pricing power. This allocation is the ultimate wealth protector, maintaining your purchasing power by owning assets that can pass on rising costs to the consumer. To summarize the anti-fragile portfolio, we've covered 3 distinct, low-correlation disaster scenarios, not one single prediction. By applying Dalio's holy grail of diversification, not just across asset classes, but across economic regimes and scenarios, you build a portfolio that can handle the future, whatever terrifying shape it takes. The actionable next step is not to buy a single asset, but to rebalance your allocation toward these 3 strategic pillars. Don't wait for the next collapse. Position yourself now to profit from the resilience. Subscribe and find the full asset breakdown in the description below.